talking about the role of marketing for private equity and VC. I think first thing I need to do is kind of set the stage of who I am, why I'm here, why I'm the only guy up here, and why I've been given the grateful work of talking to you about marketing. Next slide. My most needed slide is talking about myself, but I'll do it just to establish credibility, as I like to call it, for public speaking. So my background, I'm a chartered accountant, boom, CPA. I'm an accountant, not a marketer, but I graduated from the Schulich School of Business. I got into a few roles. I started off at Deloitte doing consulting and M&A. I got the startup bug, worked with a small startup called Firm X, ended up being a huge private equity success. And then started my journey in venture capital and private equity. Started off first at Mars Innovation, early stage, seed stage, Series A investor. Moved on to United Nations. I worked for their clean tech VC program. What I didn't know about Mars Innovation at the time was a lot of the companies I worked with were early stage AI companies. So Jeff Hinton, who's known as the godfather of AI, he was a professor at U of T. The group I was working with was commercializing a lot of what the PhDs and postdoctorates coming out of that were doing. So luckily, I got to see a lot of those and I made great connections. Moved on to the United Nations, clean tech VC. The only investment that I was part of there was not clean tech VC. It was actually Service Titan. Anyone know what Service Titan is? Yep, just went public recently on the NASDAQ at a multi-billion-dollar valuation. We were the seed stage investor there. And then went to TELUS, did some work there, juggling between M&A, which is buying companies, as well as the VC side of things. And then made my way over to Omer's Ventures. Omer's Ventures at the time was the largest VC fund in Canada, known for our Shopify investment, which I was part of as well. We invested Shopify at the Series A and then became a multi-billion-dollar transaction for us. And then there was a number of deals we did there as well. So grew up there, I call it, learned my chops of investing using someone else's money, which is a great thing to do in the investing world, and became partner there, writing my own checks into a variety of different businesses. Then 2018 rolled around. Trudeau had legalized cannabis in 2016. In 2018, Canopy Growth came after me, wanted to hire me to help them run their private equity and VC arm. So I joined there, thinking, knowing it was going to be a multi-billion-dollar industry, but how I was going to get there was the fun part. And in 3 months, we spun it out. We took it public, raised $100 million of capital, and then became the largest issuer on the TSX Ventures. Then graduated to the TSX. Then the cannabis industry imploded. And then we rode the roller coaster up and down until we had 3 exits in 16 months, which really changed the company. At that point in time, I took some time off. Went to pretty much spent about 4 months trying to figure out where the world was going, and fell in love with the model of a long-term hold. So our business, my business, Defined Capital, we buy software businesses. Typically, we like to buy businesses from baby boomers who are looking to retire. Nothing is wrong with these businesses, but they just need to retire because they're close to 70 and they need to take some time off to enjoy life instead of running a business every day. So we go in and we create succession plans for them, and we end up buying the business. Launched 9 months ago. We raised about $40 million of capital as a solopreneur. Bought 3 businesses and are on the pace to buy the 4th one by the end of this year as well. So pretty excited about that. A couple of other things to add. I am a professor at the Schulich School of Business. I am an adjunct professor of strategy and policy. I've been teaching there for 13 years, EMBA, MBA, undergrad, all that sort. So I have close ties to academia. I actually enjoy it. And there's a number of reasons, and there's a number of positives that you get off of that as well, especially free software. So that's enough about me. Let's talk about the actual stuff that we're here for. So why marketing metrics matter for investors? So I have a different lens of marketing than many of you do, being in the marketing field. My view is from an investor point of view. So you might agree with some of the things I say, you might not agree with some of the things I say, but to the perspective of the investor, marketers are master storytellers. Not only are they going to tell us what the future of the business is going to look like, but they should be building the narrative of how the business got to where it got to today. So for investors, we want to understand 3 things when we look at a business, whether it's the PE side or the VC side. 3 things we want to look at. Number 1, scalability. Can this thing grow with less people and less manpower? Number 2, is there a strong demand for the product or service? What does the market fit look like? Product market fit. Product market fit isn't a static thing. It's not like it exists and then it's there forever. It's dynamic. You're there, you got product market fit, and then generative AI comes, open AI comes, and just shoots you in the face, and you got to figure out what to do at that standpoint as well. And number 3, efficiency. Are resources being optimized for growth? Ask any VC and PE guy, mostly VC because you can't control the companies or minority stakes, and they will tell you a number of stories of how they've invested in companies, everything looked good. Once the investment was done, something happened in the company, and efficiency started to erode, and then the business started to turn upside down. So next slide, please. So before I jump into the VC side and the PE side, I want to just set up what they mean in general. So for those who don't know, because I know a lot of you come from a marketing background, I just want to lay the land of what VC is and what PE is. So venture capitalists, they focus on high growth potential companies. They take bigger risks on early stage. You haven't really developed the company yet. Maybe you're early in revenue, maybe have no revenue whatsoever. And they look at things like rapid revenue growth and customer lifetime value to CAC and product market fit. My perspective of VC is you're buying a call option. Anybody know what a call option is in the finance world? Okay. It means that you're buying a stock. Let's say a typical call option. You're buying a stock before, so you're not buying a stock. You're buying the option to buy the stock in the future at a predetermined price. That's what VCs technically do. They go into a company. This company's making whatever revenue it is. It's typically cash flow negative. There's no money coming out of this business. From a core finance perspective, it's worth nothing because there's no money. There's no profit. But they're valuing the business on the future potential of turning a profit as the business continues to scale. So in essence, they're buying a call option into the company. Now, their hope is that someone else comes in later on and buys a call option that's deeper into the valuation, and they get to mark up their investment. So that's the lay of the land that they do. And I'll talk a bit about the inside baseball on VC that not many people talk about. I don't know why nobody really talks about it, but there's value in understanding how their mind thinks through these things. The second perspective is on the private equity side. So on the private equity side, it's all about profitability, operational efficiency. We look for established businesses. We don't want wonky financials. We want something stable that you can predict, that has historical trends to it, and you can kind of tell where there are areas that you can improve. So metrics we look at are EBITDA margins. That's earnings before interest, taxes, depreciation, amortization. It's a proxy for how much cash is coming out of the business, especially on the software side where there's no machinery or inventory. Retention, how much of the customers do you keep, and the ability to scale operations, which is important for both private equity and VC. Next slide, please. So these are the key metrics that VCs look for. Before I jump into it, I just do want to talk about the inside baseball here, because it's important to know how VCs really make money. And many people believe that VCs make money off, I invest in this company, and then I sell this company, and then I get a return off of it. And that's true, it is. But like a VC, a prominent VC, I'm not going to name who it is because I'm going to bash what he said for a moment. Like he told me when I was a principal at the time at Owers Ventures, he said the carry, which is the part that you get for selling the company, it's a cherry on top. And let me explain to you how that works. So look at this little flywheel here. We're going to start off at the top here. The VC firm gets investment dollars in from limited partners. These are investors within the business. Then they go and they invest into a startup. The startup grows, the startup exits, there's money that comes out of it, and then that gives them the ability to go and invest more into companies. That's how all of us know from an academic perspective how VC works. Now, the real truth to it is, especially in Canada, the exit and distribution are very hard to get to. There's only a handful of companies every year that actually get to an exit. And there's a smaller amount of those that actually get to an exit that's worth talking about and worth chasing on the next deal. So a lot of these companies are just stuck. They're stuck because they haven't got to the exit. There's no buyers for it. And there's no active way of, like, you're not supposed to sell your company in VC. You're just supposed to build your company. That's what they say. So a lot of these VC funds, the way they make money is on management fees. A lot of these VCs, they get 2%, like I say, all of them, or 99% of them, they get 2% management fees off of the amount that they raise. So if you raise $100 million on your first fund, what's 2% of $100 million? $2 million, right? You get $2 million of management fees, which helps you pay for the rents, the software that you need, the flights that you need to take to visit these companies, the associates, analysts, accountants, lawyers, etc. And then you go and invest in the businesses, you invest in the startups, they grow. But you can't get to an exit yet. But what you're hoping to do is to get some other VC to invest in your business as well, the business that you invest into. Now, that's the weird part here, because let's say all of us, we had a fund and we found OpenAI at the early stage and we invested our dollars into it. And then OpenAI comes back, Sam Altman comes back around and says, hey, I want to raise our next fund. And we had the funding to put the whole money in. Why wouldn't we take the whole thing, right? Why wouldn't we double down on this explosively good idea? But a lot of VCs don't. Instead, they say, we'll play along, but you have to find someone else to lead it. And the reason they do that is because they want someone else to value the business in order for them to mark up their investment so they can skip the exit distribution and go back to the top and raise their next fund. And then they go and raise off of the paper profits they got, 200 million. Now they're making 4 million management fees on the first one, 2 million on the next one. They're at 6 million, bigger salaries, more employees, more travel, etc. This is the perverse nature of venture capital. But the more you understand, the better it is, because once you get VC investment, guns at your head to say, go find the next investor to invest in your business in 18 months from now. And start doing that about 6 months from the time we close this deal. And not many entrepreneurs do know that. So it's an important concept to always remember as you're raising VC money. Now, these are the 4 things that as a VC or as a former VC with a bunch of PTSD that I would look at within the business. First off is the customer acquisition cost. How much are you spending to bring the next customer in? And is that scalable? Is that going to reduce as you go and more and more customers because now you have network effects and everyone knows about your business, or is it going to stay up? The second thing we look at is customer lifetime value. For that customer that comes in and the amount of time they stick around, how much money are they going to produce for the company? That's an important concept for us to know, because if it's scalable, then that works. If it's not, then you're just going to lose that customer and then you have to spend again on the CAC to get the next customer. The third metric we look at is monthly recurring revenue. This is both a valuation multiple and it allows us to know how sticky the product is by knowing how much customers stick around and how much they do pay. And the last piece is churn rate. And I know we're a business-to-business community here. How many of you are involved in or have been involved in B2B software? Okay, majority. Anybody do B2C software? Yeah, B2C software, it's a different beast. Your churn rates are much higher. Instagram, which I think is one of the most valuable B2C companies that we've ever seen in our life, has a 33% churn rate. As in 33% of their users go, and then they come back, many of them do, but they have to, they're on a monthly basis, they don't continuously use it. So the B2C side of things has much more churn than B2B does. Next slide, please. These are the key metrics that PEs look for, private equity. So on the private equity side, just to give you a bit of background, it's a bit different. You raise money, you go and buy businesses, traditional private equity. Then these businesses grow, and you have to find someone else that wants to buy the business. Typically, it's a strategic buyer, like a company that's in the industry that's much bigger, or it's another PE fund that has a bigger checkbook that they can buy and make the thing even bigger, and then you sell it. So the typical hold time for private equity is between 4 to 7 years. The earlier it is, the better it is. Seldom do private equities go public, especially in Canada with their companies, but that's also an avenue. That's a home run. That's a big thing. And then they take that capital and they have to distribute it back to their investors. And then once they do, now they have a DPI, which in another sense, like they've returned money to their investors, and now they're ready to raise the next fund, especially after that first investment pans out. So 4 things we look at from the private equity side. First off, it's retention rate. How much of your customers stick around? Incredibly important on the software side, because the more they stick around, the better debt terms you get to buy these companies. Private equity uses a lot of debt. Venture capital uses no debt. But you can get better debt terms the higher the retention rate is. You look at gross margin to see how profitable the company is. On the software side, you look for gross margins of at least 80%. A lot of investors on the software side don't even touch it unless it's at least 90%. So that's important. You look for EBITDA growth, again, earnings before income taxes, depreciation, amortization. It's a proxy for cash flow. So that's a strong indicator of financial health. And then net revenue retention, which is to say, if I lose some customers, the customers that are currently around, do they buy more things from our business? Can we upsell them? Can we cross-sell them? Can we increase prices on them? A lot of things that you do look at. What I've noticed, especially in the world that we live in, and that I live in, which is we do transactions anywhere from $10 to $30 million valuation companies. A lot of these businesses lack on the good ones. They lack on the go-to-market side. They don't have marketing. They don't have sales. We bought a business in March of last year, the first one of the three, that had been around for 28 years. Never hired a marketer, never hired a salesperson, never even called customers unless there was a problem. So when they called the customer freaked out. He's like, what happened? They never even called customers. So when we looked at the business, we said, well, how did you get these? It's a municipal software. How did you get these municipal customers? And they said, well, someone works at one municipality and then they move to another municipality and we bring our software over. Or they're all friends, run WhatsApp groups together, they talk to each other, and then they refer the product. And sitting in all of your shoes, as the quasi-marketer that I call myself, the light bulb came off my head. I said, well, you don't even call customers? No. Okay. All right. So we know that your distribution sucks. Let's look at your price. When's the last time that you changed prices? I don't know, maybe at least 15 years ago. Okay, so we've had 7% inflation for like 2 years, and your wages are increasing, but you haven't even thought of an increase in price? No, we don't want to scare the customer. Okay, let's go to the next one. On your net retention rate, how much of your customers do you lose? 1% per year? Okay, so your customers aren't leaving, you're not changing the price, and you haven't gone to find new customers. And then all of a sudden, the light bulbs go off in our heads, and we're like, okay, like this is a company we want to dig into. And we thought that was an anomaly, but that exists across software, especially older software. Solopreneurs, entrepreneurs that had started these things in the 90s, early 2000s, they're not comfortable moving on price. So there's a clear opportunity here to jump in and really help the business out. Next slide, please. So how marketers can help attract VC investment. There's a few things to emphasize. One is the growth strategy. Second, clear path to scaling rapidly. Third, strong CAC to customer lifetime value ratio. Fourth, differentiation. You want to show validated demand with early customer traction. What I want to preach here to many of you marketers is the value of the narrative, of the story, because to an investor, that means a lot. I love meeting companies that aren't ready for us to buy yet, and on the VC side that weren't ready for us to invest yet. And I wanted to meet them. And I wanted to understand their product, their passion, their vision. And over a period of time, I wanted to just watch them. And I wanted to watch them go from 0 to 1 or from 1 to 10, depending on what stage of the business that was in. And I would say that was what I looked for at the seed stage. That's what we looked for at the Series A, Series B, and all the way to, I think the oldest deal I did was the Series J, which was like a busted company, but they raised a lot of money. And in that whole process, what I wanted to see was when I first met you to the point that we're ready to invest in your company, how has your company progressed? And that narrative was very important because us VCs, no matter who you are, I don't care if you're the biggest VC in all of Canada, which I don't want to name names, but I know, because I'm going to say he can't even go and do a check by himself. That's a large amount. He has to go to an investment committee. And when you sit in front of your investment committee of all the other VCs in your fund, you have to go pitch your investment. You have to say, well, this is the company we should invest into. And everyone starts poking holes. The biggest hole they poke is, what makes you so lucky? Why do you get to do the deal? And none of the other VCs in Canada are looking at this. And you have to explain it. And the strongest thing you can explain is a narrative. Guys, I saw this company when it was 2 guys in a garage. Now they have 33 employees. They raised $2 million from grants and early stage investments, and they're ready for a Series A. Their CAC to LTV is 4 to 1. They've been pacing growth of 300% the first year, 100% the second year. I've been watching them the entire time. Throughout that entire period of time, I've been helping them out behind like the scenes. I've connected them to engineers that I've seen that were in the market, marketers that were in the market. I've given them recruiting advice, and as well as helped them with valuations and some accounting matters as well. I'm a CPA, so that's the value add that I can give. And now they're ready to invest, and I've created a great relationship with them, and they want to put the money in. But that narrative wasn't me developing it; they developed it. They pitched it to me. They said, "This is how I went from 0 to 1 or 1 to 10, and I'm ready for investment." And that's a very powerful thing to do. So I like the storytelling part of marketing. I think is of the utmost importance. And my last line there is play the long game. Even if you're not looking to raise, go talk to investors. There's nothing wrong with it. Tell them your backstory. Tell them what you've done. On the best case, you get a deal later on when you're ready to take investment in, and you're not just explaining the story from scratch. They know who you are. They know that you haven't done anything weird. On the worst case, if you don't choose them for an investor and you choose someone else, VCs start salivating. They say, "Oh, shoot, I missed that deal. Fuck, I wish I was there. I want the next one." The best thing you can tell a VC or a PE person is no, I don't want your money. That makes anybody go wild. Even if they work semi into your company, when you say, "I don't want your money," that makes them go wild. They want to invest in the next one. When's your next round? I'll be there. I'll follow your company. I'll give you value-added services. Next slide, please. So now I'm going to go into a bit of a case study. I'll go back to 2012, 13, somewhere around there. An entrepreneur comes, tall, handsome man, comes to our investment committee and starts talking about his company. And he says he founded a company in Vancouver. Company's done very well. We've grown from this to this, and we have these marquee customers, and now we're at 40 employees, blah, blah. He goes through about half an hour of the pitch with this slide in the back, minus like the back thing, just a big zero. And I'm just sitting there, I'm like, what the fuck is going on? Why and I just want to put my hand up and say, do you need to change the slide? And nothing, like he just keeps going. And I see there's two, because in every one of these pitches, there's one or two professionals from our VC fund that they're like the sponsors of the deals, and they're the ones that brought it in. And they're like smiling and nodding. So I'm like, okay, they're in on it. This isn't a mistake. Okay, let's just keep watching it. He goes through 20, 30 minutes of this beautiful story laid out of how he went from 0 to wherever he got to. And then he pauses and he says, "And you might be wondering why there's a big 0 behind me." And we're all like, "Yes, please, it's been fucking 30 minutes. Tell me right now, why is there a big 0? He's like, "This is how many customers we've lost since launching." And I get goosebumps thinking about it right now. It was like a mic drop. We're like, "Yeah, we're all in. Let's do this." Beautiful story. And the key metric that he wanted to present was their churn. 0 customers we've lost in 18 months since launching. It changed everything. We invested into it, and it became a great success for us. Next slide. So on the PE side, how can marketers attract investment? You want to demonstrate 4 things that I think are really important. Number 1, strong financial projections and a predictable cash flow. Tell me that the history is a great precursor to the future, at least as a baseline. Tell me that when we take over the company, the world's not going to fall apart. As in, your best customer isn't your cousin or someone you went to school with that's friends with you and is only giving you being a customer to you because they have a relationship with you. Tell me that your business can survive and thrive after we bought it. Number 2, high retention rates and operational efficiency. I love it when I see a business where customers don't leave. And when customers don't leave, one of the first things I think about is, what's your pricing strategy like? What did you do on that P in the 4 Ps of marketing? How did you price it? And a lot of times I hear, we have this one price that we give with one upsell opportunity that we call them afterwards. And to me, that's like a poor man's version of pricing, because that's cost plus, and I don't like cost plus. I like value pricing. I want to see companies that have 3 pricing tiers: good, better, best, and they increase prices at least by inflation every year, and they're not scared to increase prices more. That's something that I want to see, but we need to see high retention rates before we can talk about pricing, because if you keep telling me your customers don't leave, then we can think about how we can milk it for a bit more. The third one is a clear roadmap for operational improvements. There was a business I saw about a year ago. It was in cybersecurity. It was a software, very niche. The owner was 34 years old and he wanted to sell, which is like weird to me because the business looked great. I was like, why don't you just stay here and just keep doing what you're doing? Retention rates were high and so forth. And we looked at the business and we're like, there's nothing we could do after we buy it to make it any better. So I would suggest if you have skeleton in the closet that's like, hey, we can improve this when we haven't spent much time on it. And maybe it's something as simple as we only sell in Canada. We can go to the US, but we've never really tried to. Anything of that sort. If you just throw that out there to a PE investor and say, there's an opportunity to grow this thing with your relationships, your experience, and so forth, once it's in your hands, then they can just internalize that as their own investment thesis. But if you do everything perfectly and you're like, here you go, only strategics will really want to buy your business. The financial buyers, which are private equity VC, they wouldn't, or not VC, but more private equity, they wouldn't really be interested that much. So key here is highlight the history of consistent growth and profitability. Next slide, please. Metrics that signal scalability. I saw this quote years ago, and it's been on my mind all the time. Software metrics let you know when to laugh and when to cry. And it's very true. I've seen businesses that have gone from 0 to 150 million of revenue. And they've grown from 0 employees to 1,000 employees, 150 million of revenue. And we were like, this business is going to fail. And our suggestion when we're going to invest is about 50 million of that is actual profitable or could be profitable business. The other 100 million is dead weight on you. You're giving money to your customer to be your customer, and they're not even coming back. So things we look at for scalability, what's your growth rate on a revenue perspective, quarterly and annually? How does that tie to benchmarks that we see? Number 2, what is your marketing efficiency ratio? For all the dollars of marketing you spend, what are you getting back? That tells us the strength of the marketing team, of where they can progress. Customer retention expansion, we want to know what your gross revenue retention is, and then want to see what your net is. So everyone loses customers. How do these customers lose? They go to a competitor, or do they go bankrupt? They get sold. We like to, churn is fine. Everyone has churn. But we want to see churn that's involuntary, as in they didn't decide to take the whole thing and move it to a competitor, but something happened. The founder, something happened. They got hit by a bus, or they decided to liquidate because something happened in their family situation, or the business went bankrupt. They got sold to someone else. Those are fine. I'm happy with those. You can churn all you want because you would have stuck around if you didn't have those situations happen within your business's life or personal life. The ones we don't like are the ones that go to competitors. Why did you go to competitor? And then the fourth one is your sales cycle length. Now, there's 2 sides to this. So our first 2 businesses that we bought, Define Capital, were in the municipal software side. Our third business that we bought is in the hospital software side. Now, both of these have incredibly long sales cycles. We joke around that nobody in government gets paid their $75K to just rip out software and bring new software in for no reason. There has to be a compelling reason to do it. So getting into these customers takes fucking forever. It takes 18 months on a minimum average, and sometimes it takes years of just poking them until they do something. Campaign after campaign after campaign. Breadcrumb after breadcrumb of trying to get them interested. You go to a conference, buy them wine for the table. You call them after. Nope, don't want to do it. Don't want to move. The opposite to that is once you have a customer and you service them well, they ain't going anywhere. They're going to be with you for life. So it's a double-edged sword. I like long sales cycles because it means the customers that we have aren't going anywhere anytime soon. But then on the flip side, it's harder to get the next customer. So it goes both ways. Next slide. Real world success story, HubSpot. You're all marketers, most of your marketers here. How many of you know who HubSpot is? All right, great. So HubSpot is a great story of when they did their initial VC round. And their initial VC deck, which is publicly available, you can take a look at it. The key metric they were pushing was their CAC to LTV ratio of 4-to-1. And the churn rate was below 5%. Now, HubSpot now is probably completely different because the CRM platform has really progressed and matured. It's not like just like a Salesforce type of blanket CRM. There's CRMs for every industry and everyone specializes. Recently, I saw a CRM that just helps pharmaceutical companies deal with clinical trials to make sure they can manage all of them. So niche, milks money, and is like one of two providers of that entire software market. But at the time, there weren't any niche vertical CRMs as kind of broad like Salesforce and HubSpot, and they had a low churn rate of 5%, below 5%. So the result was they attracted VC funding early. They put their foot on the gas, which is what you should do with VC. And then they went public in 2014 with strong retention rates and a scalable marketing strategy. And the wheels fell off, and they came back on, and fell off, and came back on. And then that's the public company story. Next. Here are some trends for 2025, which I believe, I mean, take my word for it if you want, but this is the perspective that I have talking to my peers in VC and being in private equity. VC is still in hibernation. Interest rates were high for a while. Their investors were saying, well, if I get 15%, if I'm lucky with you, on an average annual, it's called an IRR, but the return that you get on average per year, and you have a lot of risk, why don't I just go and invest in a GIC and make my 6% with low risk? Like, what's the point of doing this? So when the VCs knew that they couldn't go out to raise more, they started to become a little bit more picky, knowing that this might be the last dollar they put into motion. So because of that, the VC's in hibernation. Nobody's raised the new funding forever, I feel. We haven't seen anything newsworthy from that perspective. Private equity, on the other hand, has a lot of money, but they're being selective because interest rates are high. Private equity is driven by debt. There's leveraged buyout. Many of us know the term. They take on debt to help you buy the business. That debt has a high interest rate. On top of that, you're talking about tariffs, which means you're going to take away another 25% of your margin there. These businesses can't survive. So a lot of VC and private equity is in hibernation for the moment because, point two, we might be going into a recession. We don't know. We don't know who our leader is going to be in a few months from now. We don't know what south of the border that leader is going to do to us in a few days from now. And because in any situation where the market is in flux, the money stops because they just want to see how it plays out on a macro level. There's an old adage that says whatever investment you make, only 30% of that is in your control. The other 30% is in your industry. What's happening to your industry, which isn't up to you, but it's just macro. And then the remaining 40% is what's happening to the broader economy. The dollar, tariffs, not up to you either. So if you can't control a lot, and especially right now when the whole world is in flux, you can't really do anything. So now there's an increased focus on retention. We're going to go into some storm of some sort, economy-wise. How long can we last? And tell me that your customers don't leave you, because it's going to be weird. They might have to leave you because they go out of business, but if they don't go out of business, tell me they're not going to go anywhere, and that your company still remains the same. Another trend is adoption of product-led growth strategies. AI is a big thing. I put into ChatGPT, take dude, where's my car, and make it into dude, where's my AI? Because every investor will ask their companies that they want to invest into a simple question. What is your AI strategy? Are you using AI at all? Are your competitors using AI? What's the chance that DeepSeek, ChatGPT, someone else will come in and just beat you up? And we do our own work on it. Don't get me wrong. It's not like we're just basing it off of the response. But we want to know that there's some sort of a future-proofing strategy with AI going on in the head of the founder. And then lastly, there's greater scrutiny on marketing efficiency during fundraising periods. So because the world is in a weird place, because VC money is in hibernation, because PE is holding on to capital, trying to see what happens to the economy, there's a lot more attention on efficiency. Are you using your dollars well? Because once those dollars run out, unless you're a fucking rock star business, chances are that there might not be any more money coming into your business. Can you survive? Next slide. Scalable marketing strategies for marketers, product-led growth. There's different tiers that you can create. A lot of businesses I see in my world, they don't have the good, better, best type of pricing model. create more optionality for customers. There was a study showing that when it was a big marketing firm, they did this study, and if you're a marketer and you hear me butcher it, please make a face for me. But they were servicing the beer industry, and they had a single beer, and 100% of it came from the single beer. So what they did was they launched a discount beer, and they found that 10% went to the discount beer, 90% stayed with the primary beer option they had. Then they launched a premium beer, and they found that 10% were in the value one, 20% went to premium, and then 70% remained in the middle. And they cut the value off. And they noticed that while the premium was there, some customers were going, most of them were remaining to value. So they created ultra premium and kept the premium there, and they saw that the premium became the focal point. This is all to say that when the businesses that I've seen, I think the general consensus is if you have a 3-tiered pricing model, the middle one is what everyone likes to choose. The top one is the most expensive one. The bottom one's very basic. You don't get all the functionality. So you have to structure in a way that it's a no-brainer to go to the middle one. And then you can move the price points to the middle one. It has more value to it. The second point, our referral programs encourage customers to bring in others. We have bounties that we give our customers to tell them to bring more customers in. They get a piece of the pie for every new customer we get. There's automation tools, AIs to help your CRM platforms and make more decision making. And then there's content marketing, which is a big thing, both authority and educational resources. Now I have these things written here, and you can see it's kind of like this ugly font. And what I did recently, and I saw this huge pickup, was so we reach out to businesses. We have about 3,000 vertical software businesses that we touch base with. And we send them emails, we go on LinkedIn, we send them messages, I call them times, like the good ones at least that we want to invest into. And what I started doing, I just tried it, was writing handwritten notes. And nobody gets mail anymore, right? We all get like bills, but nobody gets like a letter unless it's like Christmas and someone sends you their family picture or something and you have like 10 of these. So we started writing letters to them saying that we're big fans of your business and I know you're not looking to sell, but when the time comes, let me know. In the meantime, these are the services we can provide. And that works. So then I digitized my handwriting, which is that ugly chicken scratch thing. And I started sending more of those out. And we have this incredible pickup rate. And I'm not saying like they're ready to sell to us, because that would just be too good to be true. But they get on the phone with us at least. And it starts the clock of creating a relationship. Because I know that once we get them on the phone, majority of them will stick around because I'll contact them every 3 months to see what's up. Next one. This is really important from an investor perspective because we want to know that the company that we're investing into or company we're buying is data-driven. Now, this is more on the VC side than the private equity side, because private equity side, we can just do it ourselves, we have control. On the VC side, you don't have control. So you want to know that the marketers, the founding team are data-driven in how they think. Do they have analytics tools, Google Analytics? Do they use a CRM like HubSpot? Do they track and obsess over metrics like we do on CAC, CLV, net retention rates? Are they skilled in digital and performance marketing? Do they have the necessary skill sets to build this? And we want to take a lot of what marketing does and put it into our own system. So when I was in VC, we used to always ask our portfolio companies every month, give us these key KPIs, key performance indicators, that help us understand how your business is doing. And we're going to track that. And month over month, we sit down, all the investment committee, and we look at our 30 portfolio companies and say, how are they tracking from the month before and relative to their peers? And what else have we seen? A lot of investors see competitors because they pitch to us as well. And we can take their numbers and match it up to our own portfolio company and say, how do we match against that? Knowing that anything promotional we get from a competitor is probably covered in glitter and looks nice, but might not be the truth, but it's close to it. So that's a very important piece for us. So what you can do as a marketing perspective on the investment side of things is to feed the team that goes out to fundraise or even show up there as well to help them get there through metrics and giving them the stories. Next slide, please. So you want to align marketing with investors' expectations. Keep it simple, 3 to 5 marketing metrics, nothing crazy. Prepare a clear data dashboard. So if you don't even do this, then just implement it. If you don't even use it, just implement it anyway. and just track all your metrics for a period of time and show how things have progressed. Very helpful. Show proven strategies. If something worked, if you have this campaign that you did and it turned out to be good, gloat about it, talk about it. We did this, we didn't think it was going to work, and it worked out. Now, behind the scenes, you might have tried 6 other things and they all sucked. But that one thing that worked, just keep talking about it, because you're proving to that investor, whether it's PE or VC, that there's an opportunity to scale off of a bespoke marketing campaign that you came up with. The fourth one is align goals. Set your KPIs and tie them to investor objectives. You know what the investor objectives are. So when you're giving your 3 to 5 KPIs, talk about how that will help their investment. And then communicate. I think that's something that we see all the time, where business is great, but the pitch fucking sucks. It's just poor. They haven't rehearsed it. There's multiple people talking at the same time. There's people in the meeting, this irks me, that they don't even speak. They're just there. And the whole time I'm thinking, who is this person? I didn't see them on the team slide. Are they part of this team? Or do they come off the street? And then this one time I was like, does the founder think that person's on my team? And I think that person's on their team. And this person's from like a competing VC firm that just sits in here. I was like, I have no idea. And then my mind just goes off of the pitch, because mind you, like, we're looking at 8 to 10 pitches a day, and that's like hours of sitting there and everyone telling me their company is the next ChatGPT and the next Sam Altman. And so anything that you can do to distract, which is like not getting everyone to talk, these things stick around. And then on the communication part, I know we're all very professional. Never, ever, ever get emotional on a deal. Even if an investor takes you through the ringer and you've done all that you can, don't go out and tell them to fuck off when they say you can't do the investment. I've seen that happen. I've seen it come and haunt people. They said F off to us. We were like, why? Okay. And then years later, they came to pitch us another company. Another company was a great company, but we said, I love the pitch. Thank you for coming in. I know it's water on the bridge, but we just can't make the investment. And we didn't say why, but internally we said it's because you were unprofessional just one time. And it just shows us that in this courting stage, it's like you're dating. You shouldn't be showing like your worst side of you when you're dating. You show that after you get married, right? So you want to be as courteous as possible. Next slide, please. AI is a big deal. I do want to just briefly go over this. If you're not actively using AI in your marketing, you're behind. So using marketing, your content, so AI in your content generation, your distribution, and answering comments on social media, it's all helpful. Nobody wants to see you primarily use AI, because we've seen when ChatGPT pumps that stuff, there's all these like emoticons in the same place every time, and the writing on the bottom is the same. You see it a few times, you can call it out and say, you put no effort into this. But using it to like reduce the time it takes to create your content, I think is a great thing. This picture is Uber. These are 2 phones that at the same time, 2 people right next to each other order an Uber from the same spot to the same location, and they got drastically different prices. And this was posted on LinkedIn. Everyone went fucking crazy, and they said, this is insane. How can Uber be doing this? They're the devil, blah, blah, blah. And I looked at it from your lens, which is a marketer, and I said, of course, dynamic pricing. Come on. They live in the AI world. You have all this data like Uber does. You know, like the credit card information of whoever a user is. You know, if they went to Sweat and Tonic and they work out here, they don't go to Good Life. Of course, you can charge them a dynamic price and price it higher than you price anybody else, even though they're right next to each other. So they use AI to do this. And it's bespoke AI, but there's a lot of tools out there that can help you on the pricing side. Marketing automation we talked about. Personalized marketing, I think, is important too. There's products out there that we like to see companies use. Clay.ai is one of my favorite. It enriches any of the outreach campaigns. So you get some stuff off their website, puts it in there. It just makes it a bit more better, and it cuts down on the human labor costs of trying to do this by implementing AI. So one of the things we always like to ask, and I do it all the time, is what's your marketing AI stack look like? Like, what are you using in marketing? And a lot of people are like, yeah, just ChatGPT, not enough. On the PE side, as I'm buying these companies, that's what I want to hear, is you're only using ChatGPT, because we can do a bunch of different things to make things go faster. Next one. There are challenges that that marketers face. So we are. This is a chart from The Economist talking about our bootstrap or how our GDP per person at purchase price parity is decreasing relative to the U.S. But some of the challenges that we see is economically coming up, but internally, one is lack of data infrastructure. A lot of companies don't have proper CRM systems in place. They don't invest in them. They don't clean them up. They don't have proper analytics. That's important. Number two, balancing growth with profitability. And this is my own line here, but I don't like it when companies do both. If you're growing 100, 200% a year, don't chase profitability. Put your foot on the gas and grow. If you're not growing 100% per year, if you're not growing 50% a year, you're growing 20 or 10% a year, don't chase VC money. Go make money. Go make profit. So you have to pick a side. And if you're in the middle, you're not ripe enough for VC because you're not doing the things that VCs want to see, and you're not in the PE range of valuation because you want a revenue multiple and they're going to give you a profit multiple. So pick a side and just stick to it, and then feel free to revert if you need to as the business changes and evolves. But pick a side. And then high churn rates. The economy is messed up. There is a potential for increase in the risk of higher customer acquisition costs and lower retention. Here's where you prioritize customer experience and satisfaction. Talk to your customers. If anybody been in Y Combinator? Yeah, we had I probably had 4 or 5 investments that were in Y Combinator, and they preach is talk to your customer, right? That's the main point. That's the most important thing you can do is talk to your customer. And a lot of that falls on the marketing side. Now, I've seen that marketing takes that. I've seen product taking that. I've seen sometimes sales taking that. But when it's a small organization, it's typically marketing function. When you get a bit bigger, you have a product team that kind of relays information between engineering and marketing, and they're the ones that do it. But it's so important to talk to your customer. Next slide. Marketers are storytellers. Let me tell you a story. I named it Acme because I couldn't clear the name from one of our investments in the past to use the story in time. But so I'll just call them Acme for now on. In 2018, they came to pitch to us, and it was a seed stage idea. They had no revenue whatsoever, but they had this good idea. And the idea here was that they were going to create a product that would help dentists and anybody that was dealing with medical, so general practitioners, chiropractors, etc., with a text messaging protocol where you'd come in for your service, and then you'd automatically get a text message when you left of rate the service, and whatever you wrote in that text message would be posted on Google for reviews. And it really works in a fragmented market where you don't know what the service provider is like. You Google what's a physiotherapist near me, and one of them comes up with a 5-star or 4.9 star Google rating with 1,000 reviews. So that's what they were pitching. Now they came to us and they had that idea, and we're like, all right, yeah, that idea is pretty basic. It's not that crazy. The tech's not that insane. How do you know it's going to work? And they were like, yeah, we talked to 100 customers, gave us a list of the customers that we talked to. It was dental clinic in Mississauga, dental clinic in Florida, dental clinic there, general practitioner in Calgary. They said, we talked to 100 people, and these are the survey results we got. And it was just 20 slides of just, we talked to customers, and this is what we found. And any question we asked, we're yeah, we talked to 100 customers, and this is what they said about that. And one of the things that irks me as an investor is if I sit there and within 30 minutes, I can poke holes in your company, and I can ask you a question you don't know the answer to. And what I like about the companies that are the most prepared, and I think Y Combinator does a fantastic job of that, is you go talk to these companies and you pepper them with questions. And after about the 6th question, their nerves come down and you get this little smirk on their face that you can see, which is they look at you and they're like, you think you can fucking stump me? I live and I breathe my industry, my company, my idea. I'm sitting under the desk sleeping sometimes. I eat craft dinner for lunch and dinner. There's nothing you can ask me that hasn't come through my head, investor. And those are the ones where you kind of tell that aura just hits you of the person just hits flow. And they're just looking at you, just giving you these answers of, yeah, we looked at that, and we looked at that, and I'm going to give you the 3rd derivative of your question because we kept going with that. And those are the most powerful things you can have is experience. And a lot of that comes from talking to customers. Next one. So some closing insights. Brian Halligan from HubSpot said, what separates good content from great content is the willingness to take risks and push the envelope. Private equity and VC investors look for different things. VCs look for growth potential. Private equity looks for profitability, scalability, consistency. As founders or marketers, you have to align those metrics with their investor goals, understand how they think, spend time on them. Go ask ChatGPT, be like me, tell me, I'm going to ask you a bunch of questions on the VC market, and especially this VC that I'm talking to. Give me everything you got. And just pepper them with questions. Learn so much about how their mind thinks, how their fund works. When did they launch the fund? How long have they been in the fund for? To understand what metrics really drive them. Have they made money on their fund already? And now this is like the cherry on top because they have to spend the money? Or are they early in the fund and looking for winners? Different type of investment that you can see on both sides. And always remember that marketing is a key driver of valuations and investment decisions. I wouldn't tell this to any other function out there. Maybe sales a little bit, not R&D. The product, you can diligence the product pretty quickly, but how you tell the story in a crowded market is incredibly important. And especially on the VC side, if a company can do that, if a marketing team or marketing leader can show you that, can show you this is what we've done, but this is what we can do as well, that's very powerful, and that's what you can take to the bank and the investment committee. Next slide. I'm going to step away from the talk, and I'm just going to say we are hiring at Defined Capital for a manager of demand generation. We're searching for kind of like a unicorn who can do digital marketing, help us with content generation as well as ads. So if you know of anybody that wants to join our company and help us with both Defined Capital, find more businesses to buy, as well as our brands or portfolio companies, please let me know. We do, you'll own the process, so you can do your own thing and be creative with it. We have a competitive salary. We provide equity and a path towards becoming a CMO of the entire thing. So there's a lot of growth that's involved out there. I have a QR code there, hopefully it works, but that will take you to our LinkedIn job posting. Next slide. Thank you so much. Any questions after that verbal diarrhea? Sure.
So when assessing risk, what would you say are the biggest red flags?
Risk in terms of what part of it?
Like when assessing if the company is high risk, if it's volatile, what's the best position? What would you say when companies, this is the biggest red flags to see with a founder of the business?
Yeah, the biggest red flag from a risk perspective, I would say, is when they don't know the economics of their own customer base. So when we look at the math, and this happens a lot, and we say, all right, well, you're selling to your business, you're hitting growth rates, but for every customer that you're bringing in, you're slapping $20 on it and giving it to them. Like you're paying them to be your customer, which is okay. The second stage of that is, do they come back? No, they leave after 6 months. So you're giving them money to be your customer and then they're leaving. That's not a real friend or a real customer. That's like a fake friend. Like they're not there for your product. They're there because you incentivize them to come. They didn't like it and they left. And it depends on the industry, but once that happens, in certain industries where sales cycles are lengthy, like even if you make the product 100 times better later, they just have a bad taste in their mouth. They don't want to do business anymore. So, and if you drill down a bit more than that to the churn, you find out why they're churning. There's typically something wrong with the software. It's buggy. It loads slowly. It kicks them off. They lose their data. There's always some inherent reason why they came off of it, and that's probably the biggest risk that we see.
So how come you don't invest in pre-revenue startups at Canadian VC?
There's a robust angel community for that.
Zero compared to the States.
Compared to the States.
Canada's different.
Yes, so Canada is different than that. It's just the risk factor of Canadian investors, I call it. Like I'm an angel investor, but I'm also risk averse to the whole segment of it because you just don't see the number of exits that you see in the US. You don't see the pedigree of founder, I think, is the same. Like we did this study one time at Omer's Ventures where we looked at the time it takes from founding to exit. And the time it took in Canada from founding the company to exiting the company on average was 9.6 years.
Yep.
Anybody want to guess what the US was? 9.2 years. So it's not that much of a difference, but we think it's half, which makes us scared of investing. So I think a lot of it is psychological than it is like what we see. And it's because a lot of these Canadian companies that got bought by US companies, they can't talk about it. They don't talk about it. They don't talk about the terms. When you're behind one, once you're an angel investor and one of them succeeds, you get hooked. You're like, maybe I can do it again. And then you lose a bunch of money. And then you get smarter on like the sixth one. So it's a learning curve for everybody, I'd say. Yeah. And we need to push that more of an agenda. There's a question over there. Did you have one?
So I have this question, like you talked about compelling storytelling. So what is more important? Is it like the storytelling or the numbers? Because sometimes it happens that the business has a compelling storytelling, compelling story, how it started, but the numbers are not supporting it. So I mean, just an opinion. Like,
It's all of the above. It's all of the above. You have to have the numbers, which is the hard part to do. And then you have to wrap it in a nice story. And your story is to say, I'm different from the other 10 investments that you saw today. And the other 100 that you're going to see in the next 2 weeks from now. Like, I'm different for these reasons and watch my path. And if you miss this, and you're not saying this, but you're kind of signaling it. If you miss this, I might not let you in on the next one. And that really salivates people. Like when I fundraised for Defined Capital, and it never dawned on me until after, I knew the VC industry, like, you got to make them, like, we would salivate every time someone say no to us. We sat in a term sheet, they're like, now we're good. We'd be like, why? We spend all this time, energy, legal fees. And then I was like, Defined Capital side, naturally, I said no to someone. And that person became the best investor that I ever saw, like overnight. So it is kind of like, I do look at it as kind of like dating in a sense, like you're dating, but you also want to be hard to get. You want them to work for you, but also you want to put your positive side out and tell them a good story, you're a good person, you're kind, and you've done all these things, and blah, blah, blah. At the same time, like, hey, but I'm still testing you as much as you're testing me. And I think putting it all together, you need it all. You need it all.
and just another thing, just very recent, like you were talking about recession and AI. So I think VCs are also like talking a lot about it. How does these kind of disruptions in investing impact VCs? Like, because previously, like things like ChatGPT, they were like billions of investment, and something like Q is like just 5.6 million. So how does it impact VCs?
I think it's just the flavor of the week. So if you were to ask a VC a month ago about vertical AI companies that use ChatGPT, like they're built off of OpenAI, then like investors would say, yeah, but like you're just wrapped around another LLM. And then 3-4 days ago, DeepSeek comes out, and now VCs are like, all right, so the foundational models are a commodity, the verticals are important now. And you're just seeing the tide shift. And when you look at it from afar, being in the industry, you're like, all right, but you're just chasing like what the news says. And so I like the ones like, and you see these with the big investors in the US, Y Combinator being one of them as well. Maybe, I don't know about them now, but at least when the time when we used to talk to them, follow them, that they were contrarian in their thinking. They were going into different things. And a lot of them didn't pan out, but they made a lot of bets. So right now you're seeing those big firms in the US, they're buying service businesses. Like they bought a bunch of accounting firms, throwing AI into it. It's not talked about that much, but